for day traders, even more than regular analysts, that whole section I talked about before about setting up your charts holds true. No garish environments. Easy on your eyes. As few variables as you can possibly live with. You know, keep it clean, keep it simple, keep it uncluttered, let the information flow naturally off your surfaces, off your screen surfaces to your brain. If you're using multiple monitors, don't try to divide tasks between the monitors. Those charts that span 2 monitors, they're all fine and dandy, but I just don't think you can read them right. You know, put different tasks in different monitors, much the way that you would have different tasks in different windows if you were using a single monitor. Make it easy on yourself. I can't stress that enough. You know, and keep the monitors a good distance from you. How many of you are guilty of this? No, just getting too close to it, getting intent and leaning in until you got a little nose wax on the. Don't do it. Stay away from those things. They're dangerous. They glow. They have radiation. And God knows what they do to you. So give yourself a nice distance, nice comfy distance. Monitors. You know, eye level to a little bit below eye level. You know, try to have them at a natural, in a natural position so that you're not leaning forward or looking back or tweaking your neck and what you sit on, it's really important. Get yourself a nice chair. They're not even expensive anymore. Get yourself a nice chair, something with some back support so that you're not constantly slumped over. Try to take it easy on yourself. You're going to be sitting in front of that screen for a minimum of 6-7 hours a day. Give yourself a chance. So now we've got a nice clean environment. Don't use black as a background. One of the problems is it may be depressing color, but even more than that, the contrast is more than your eye can handle. It's too much. Try to get it to look nice. You really don't want, that chartreuse bar on a black ground with a purple frame. And I've seen them. So I know that people do it. White or a light cream for a background, or even a light green, or whatever pleases you, but just try to make it easy on your eyes. Something that you can, you look at it and are comfortable with, aren't straining you, that, as you pan your eyes across it, it's not going flicker, flicker, flicker. You'll know when you get to the right combination. And it's almost never the combination that the guys from the software factory, those guys, the guys at the software factory, that's what they do. They write software. They don't trade, right? They don't sit and look at those screens like that for the length of time that you do. So the choices that they make are probably not the choices you should make.
The default is black on TradeStation.
Yeah, and the point is the default is, TradeStation, the default background is black. I hate that myself. Anyway, chart parameters. Now that we've got a nice clean work surface and we can see what's going on, this is so incredibly important. If you take nothing else out of this entire day trading session, take this. Select rational bars that reflect the price formation mechanism. Just take that fact away and think about it. It's no good to be watching 3.5-minute bars. No one else is. What business are we in? We are psychologists. Technicians are psychologists. We're mass psychologists. And so we want to be able to see the picture that everyone else is seeing. We may want to look at it in a slightly different way or have alternative views to allow us to get some forecasting ability, but we want to be in tune with what's going on out there. So try to fit your bars to the price formation mechanism. Some typical choices are hour, 30 minutes, 10 minutes, and 5 minutes. Those are kind of the things that people try. They're the things that people do. So try to keep in tune with what's going on out there. If the new fad is 4 minutes, and everywhere you go on the internet, everyone's talking about 4-minute bar charts and all that, fine. Use 4-minute bar charts because it's part of what's going on out there. The reason I suggest intervals like this is because everybody's bar charts are going to be starting and stopping at the same hour. Half hours the same way. So you're probably going to have a pretty good view as to what other people are seeing. Secrets, you know, it just isn't, you don't want to be seeing something that no one else is seeing. It's just really important, you know? I mean, first of all, you're not, while it may be okay for you, you're not going to be aware of what's going on with other people. And it's other people who are going to move the prices. You're simply going to participate. Anybody here think they are a big enough trader to be setting the price? You get my idea. Day trading, Bollinger Band parameters. Start with the normal parameters. Many day traders report success with shorter parameters, sometimes dramatically shorter parameters. I get an enormous number of reports of day traders using 10-period bars with 1 to 1.5 standard deviations. I typically hear, you know, like, I'm using 10-period Bollinger Bands with 1.2 standard deviations or something like that. You get a lot of information there. A lot of people seem to be finding value in that area. So that's an area you might want to explore. A gentleman walked up to me just a little while ago and said that he was using 7-period bars with 2 standard deviations and was getting really good results. He really liked the way that the bands worked in that time frame. And you know what? He's right, because it's suiting him. He's looking at it, it's doing what he wants it to do. If it doesn't look right, it isn't right. I can't stress that enough. Be free with the parameters. Play with all kinds of combinations. Your eye will tell you right away if you've come upon something that suits your trading style. Different types of parameters for different tasks. There really, in the day trading world, there really are 2 different approaches to Bollinger Bands. One is the breakout approach. Essentially, people are looking for squeezes and breaks out of the squeezes. All right? It's the old volatility breakout system, which has been proven time and time again to be a viable trading method. I remember that Bruce Babcock, the editor of Commodity Consumers Traders Report, he interviewed me for his magazine a few years back. He's passed on now, but when he was alive, he interviewed me. You didn't realize old traders, you know. He interviewed me for his magazine, and during the course of the interview, we kind of strayed away from the interview, and we just got talking about chatting, trading. You know, what goes on, what do you like, what don't you like, what works, what doesn't work, what's impossible, so on and so forth. And he absolutely stunned me when he said, oh yeah, my favorite trading system, now this is Bruce Babcock, right? My favorite trading system is a volatility breakout system. You could have knocked me dead. It was the last thing that I expected to hear from him. And one of the reasons is, he didn't say this, but I'm sure that this is true, is because that they're so robust. When you get those squeezes and you get the breaks from them, they're really reliable. So match your bars to your tasks. Are you trading volatility breakout? Then lean towards less periods and tighter parameters than you would otherwise. On the other hand, are you trading reversals? Then lean towards more periods and looser parameters, different points of view. What do you want to do? Do you want to, come down and buy the low and go from there? Longer number of periods, wider parameters. Do you want to watch, the price tighten into a nice little coil and buy the breakout? Shorter number of periods, tighter parameters. In day trading, you really have a problem because you have this other variable, bar size. How many minutes in those bars. And so you have two different pieces going because you get a combination there. The bar size and the number of periods tells you how far the indicator is looking back. Normally, in the type of trading we do, it's just the number of periods that tells us how far we're looking back. But day traders have the additional variable. So think about that. 10-period bands on 5-minute bars, right, is one thing, and 25-period bands on 2 minutes bars is another thing, but they're frighteningly similar because the look-back period for the volatility calculation is more or less the same. The granularity is different. One's got a much finer granularity than the other, but the look-back period is the same. So think about what it means in terms of the look-back period, in terms of how long you're trading. For example, if you're trading breakouts, how long do the breakouts that you trade last? 10 minutes, 15 minutes, 20 minutes? Well, if they tend to last 15 or 20 minutes, you probably don't want a look-back period of more than a couple of hours. Relate your trading task, what you're trying to accomplish, to the indicators. Don't wildly mismatch. Don't have a huge long look-back period when you're looking for a tiny little breakout, and don't have, a little itty-bitty look-back period when you're looking to take out a big move. So match the task and the indicators. It's a very important piece of the puzzle. Futures traders. Tick volume is an okay substitute that you can explore. It may not work the way you think it will work. It's not exactly analogous to volume in the stock market, but it is better than nothing, because without it, that's what you have, nothing. And it does give you some sense of the volume of transaction, when the market's quiet, when the market's more active. For those of you who don't know what tick volume is in the futures markets, it's the number of times the price changes in that given period. So if the tick volume in a 10-minute bar were 10, the price changed 10 times in that period. If it were 100, the price changed 100 times. It's roughly analogous to the number of trades because most of the time trades occur at different prices. But a good deal of trades occur at the same price, so it's not exactly the same thing as the number of trades. It's the number of price changes in most systems. Some systems, it can be a different quantity, so you kind of have to ask what tick volume is from your vendor. But most of the times, it's going to be the number of price changes in that given period. It can be used as a surrogate for volume. And again, it's better than nothing. Here's Albertsons with 5-minute bars. I used the traditional Japanese coloring scheme here. You know, you can decide whether that floats it for you or not. Some people like to see their candlesticks colored in black. After I came back from Japan, I started looking at them this way, and I kind of got used to it. Really, what you should get, if your software will support it, if you're going to do this, then I also like to have the white candlesticks, the outlines drawn in red, because that's the way that's the old Japanese style. And I saw a lot of old Japanese charts when I was in Japan, and there was something elegant about them that captured my imagination. So I've started looking at things a little bit in this regard. Notice how I've stayed with the traditional Bollinger Band parameters here, 20 periods, look back. So that's a 100-minute look back. It's a look back just a little bit more than an hour and a half, right? And 2 widths. But notice how well these work here. All the highs are occurring right at the bands. We break the upper band once here. We break the lower band once here, and once here. So there are 4 breaks of the lower band, 1 break of the upper band. But the bands are really doing a very nice job. Here's a nice little squeeze. You break out, you go back in, and here's a nice little trade on the reversal. All right. Very nice little trade there. Here's a failure at the upper high. This is a classic reversal formation. You open, big trip up, and then close on the low. So a classic reversal formation leading to a really nice trade. I found that when these reversal formations occur near the bands, they're very reliable. Time and time again, you'll see these patterns come in, and you'll see they're much more effective when they occur near the bands than they are when they occur, you know, here in mid space. Let's see if we can find one. Yeah, here's one. Here's the same formation, huh? Right here in the middle, and you get no bounce out of it. So when you see these formations at the bands, they're that much more important. They tend to work that much better. Here's Cisco. Again, these examples are from the middle of last week or so. Look how beautifully this works. It's just a classic walk down the lower band into a transition period. You get a little bit of a squeeze here, a little bit of a break to the upside, and then a little choppy action. Finally, a 2-bar reversal leading into a decline. These are both 5-minute bar charts. So the look back period here is 50 minutes. Again, 10 period, 2.1 bandwidth. Look back period is 50 minutes. And I was really impressed when I saw this. 1 second, sir. I was really impressed when I saw this, how beautifully it walked down the lower band, how nicely we came into a low here, separated up, traded right up to the upper band, and then traded down in a very orderly manner, how this consolidation occurred and how the bands worked during this period. I thought that this is really kind of what I wanted when I looked at this kind of price structure. This is what I wanted from it. And I was surprised to find that the bands were as wide as 2.1 in order to get this type of image on the screen. I would have suspected that at 10 periods they would have been more like 1.5 or so. But both of these charts seem to me to be working just about perfectly. Again, they are both 10-period Bollinger Bands. The standard deviations employed are 2.1. Now, this gentleman first.
You call the reversal at top a classic pattern. Are you referring to the candlesticks themselves?
Yes, well, it doesn't matter, candlestick or Western bar chart. Break out of the band, fail, and close at the low of the bar. That's a classic reversal. That's a classic exhaustion pattern. Try to break out and then come all the way back down and close on the very low of the bar. It's just, I must tell you that I'm not a day trader. You know, so the examples that I draw are, you know, I go in and I look at the day trading tools and such like that, but I'm just not a day trader. So I just went in to try to find the images that pleased me, that I thought were most useful. I would absolutely employ %B and bandwidth. I would try to find a reasonably good volume indicator, and I would use a momentum indicator, such as RSI, or even just a simple momentum, a simple rate of change. Some real rigorous momentum indicator, and I would try to match my periods as much as possible, so that the indicators would either be the same length as the look-back period on my bands, or maybe half that length. We'll often find that in cycles, and since we're looking at bands, we're involved in some type of volatility cycle. We'll often find that in cycles, it's important to line things up on even harmonics. Wholes, halves, quarters, such like that often fit the cycle structure quite well. But again, I must confess, I am not a day trader. Occasionally I do it kind of when I'm bored and want a little fun or something like that, but it's not my avocation.
That green kind of moving average there, do you have any idea what that is?
Yes, that's a 10-period moving average.
It's also 10 period, okay.
Now, yeah.
I want to understand what you just said, because I think it's very important, but are you saying that if you're using 10, 2.1, 2.1, instead of using 20, 2, 2, would you want to change your RSI to 14, 7 or something like that? Is that what you're saying?
Yes.
Does that have the same speed, basically?
It doesn't have to have the same speed, but you're always looking for places to start looking for value. So if you're deploying 20-period bands, for instance, I would start looking at a 10-period rate of change for a momentum indicator. I'm not saying that 10-period will be the right number, but if you want to get in tune with the volatility cycle, which is what the information you're capturing with the bands and depicting both in %B and in bandwidth, then I would look for an indicator either of equal length or of half length and start from there and adjust until I found the right values. They're just anchor points for you to look at. It comes from cycles analysis, where they're very much interested in the harmonics, the half cycle and the quarter cycle and such like that. And I found it's just a very practical way. You know, if you're using 18-period bands, well, try 9-period rate of change and see if that doesn't fit. I'm not saying that there's a cyclical relationship here. I'm just saying that, you know, this might be a rule of thumb that will put you in the right ballpark. Now, we get back to something that I really do, and I really believe in and spend a lot of time in, and that's seasonality. Seasonality exists wherever we look. It's a very strong influence, and it can help you bias your operations. I've taken several different views of intraday seasonality here, and I think that they can really help you. So, starting with this. This is a view of the days of the week. We looked for the average gain or loss for each day of the week, and we used daily data from January 2000 through April 2002. So essentially, we're looking at the post-bubble environment. We're looking at some reflection of the current trading environment. Now, this is in tenths of a percent, right? So the effect is relatively small, but you can see what's going on here. On average, we lost just about 3/100ths each day in the past 2¼ years. Monday showed a very modest but not meaningful gain. Tuesday showed a very modest but not meaningful loss. Wednesday showed a very strong and meaningful loss. Wednesday, on average, over the past 2¼ years, has been a down day. It's a piece of information that you can use when you're making day trades. You know, on Wednesdays, you can bias your operations toward the short side.
What data are you actually looking at?
Daily data for the S&P 500. Thursdays was a very strong day. So on Thursdays, we can bias our operations toward the plus side. And on Fridays, again, a significantly weak day. So Monday and Tuesdays, on average, are kind of wishy-washy. You don't have any real indication going as to whether they're going to be positive Wednesday. You get into the latter portion of the week, and you have real clear indications. Wednesday, on average, has a downside bias. Thursday, on average, has a strong plus bias. Friday, on average, has a strong downside bias. Yes, sir?
Would that also apply to the NASDAQ or the 3Qs? That seems, since you use the S&P?
Yes, I think it's indicative of the market as a whole. I use the S&P. It's got a lot of NASDAQ stocks in it still, even after the debacle, and it's cap weighted, so it gives a feeling for what people are experiencing and such. The standard deviation is quite high on the numbers. So that's why I say, on average, bias your operations in this direction, but you know, the dispersion is pretty big.
Do you have that data for the bull market, the tail end of the bull market, to see if there was any difference, like up to 2000?
No, I computed this data for this conference just a couple days ago.
So a weak Friday sort of falls into a bear market scenario, in my thinking. You know, Friday's down.
Yes, I just wanted something that was descriptive of the environment that we're living in now. That's why I cut it off at the beginning, at the end of the bubble. I wanted something that was, yeah. It would be interesting to look back and see what this was like in the past. This is all inspired by the work of Arthur Merrill. And you can look in his book for the answers. His book is called, it's on your reading list, which is in the back of your book. It's called Behavior of Prices on Wall Street. It's published by Chappaqua Press. It's still in print. He did these hours of the day study and days of the week study and such like that. I updated them and used a little bit different methodology, but he has a lot of history in there that you can take a look at. So, if this is a good idea, let's grind it down even finer and see if we can figure out an even better idea. So I called Genesis Data Systems and I asked them for the tick data on the S&P for this year. Right? So I got all ticks for the S&P 500 that have occurred this year. Right? Roughly, what's this, middle of April, so January, February, March, about 3.5 months worth. Roughly 70, 75 trading days worth. And I, from that tick data, I constructed half-hour intervals. So that means on a given day, we start at 9:30 on the East Coast, 9:30, 10, 10:30, 11, 12:30, so on and so forth, right? 13 periods a day because we open a half hour earlier. And this is what the market day looks like from that perspective. We start out the first half hour very strong, right? Bang out of the box on average, right? Then for the next 2.5 hours, there's a downside bias. Doesn't this feel right? Run them up in the morning and then grind them back. How many times have you seen that happen? Right? Then, right here, even more interesting, I've known about this for 100 years, and I was astonished to see it here. The noon balloon. There it is. I could hardly believe it. Everybody covers and gets out of the way for lunch. Nobody wants to take any positions. They all step aside. Everybody has a good old time. The noon balloon. From the time I came into this business, we've had a noon balloon. I thought it would have been arbitraged away 100 years ago. But there it was, as big as you can see in the data. Then a very choppy afternoon and 2 closing bars. This is actually an extra bar. This represents after hours trading. Okay? So then everybody covers their shorts and squares their positions for the close. And after hours, I guess when the idea is that the amateurs play and they have a bullish bias, so we get an after hours bias. This is the typical signature of the market day, and that suggests some things to me about if we're going to be a day trader, how we can bias our operations. We can certainly buy later in the day, right? And sell the next morning into the strength, short during the early period of the day, cover before the noon balloon, and then spend the afternoon looking around for trades and trying to figure out what's going on. But, I mean, you can all take this data and use it to match your operations. But this, to me, is very strong indication, and it suggests some really good ideas about how you can bias your operations as a day trader. However, I'm never willing to leave well enough alone. So I said, maybe a day isn't a day. Maybe there's no such thing as a market day. Maybe a market Monday is different from a market Tuesday, is different from a market Wednesday. And you know what? That is the case. So again, I calculated weeks based on half hours. And I used all weeks of this year based on tick data, again, recombined into half-hour intervals. And look at this. Here's our strong opening on Tuesday. Here's our strong opening on Wednesday. Here's our strong opening on Thursday. And here it is on Friday. But here it is on Monday. Quite a different picture. So sometimes, as Winston Churchill said, we have lies, damn lies, and then statistics. So this is deceiving because this occurs on only 4 days of the week. Right? There is no such thing on Mondays. So one thing you don't want to do is buy a position on Friday hoping that the Monday morning opening is going to bail you out.
How often do you update this?
This is a day old. I did this Thursday.
Do you do it on your website continuously or just for the class?
No, I just did this for this class. Now, note that the noon balloon exists in virtually every period, although it's not as strong as it is on all days. Monday's noon balloon is really a lollapalooza, right? Tuesday's just a one-bar wonder. Wednesday's is another real strong one. But Thursday's is actually, it looks like Thursdays is actually negative. Thursday's noon balloon is non-existent, and Fridays is a 1/2 hour wonder. So that noon balloon idea has a lot of diversity during the week. How about the strong strength into the closes? It's there every single day. Sometimes on Thursdays it's not as strong as one might hope for, but it's there every day. So that aspect of market activity is with us all the time. I did this finer grind because I thought that the more simplistic picture really didn't do justice to what you were going to find. And again, I owe a debt to Arthur Merrill, because Arthur Merrill was one of the first people to recognize that the market traded differently on different days of the week. So that's been a very important part of my background in looking at this seasonality. A few more seasonality issues that I think are very important. Follow through. The open and first hour are strong after a big up day. And the open and first hour are weak after a big down day. So if you're looking to buy it and it's down, wait till the next day. If you're looking to sell it and it's up, wait till the next day. Get just, earn a little bit more, get a little bit more out of the market. Most price movement occurs near the open and near the close. Most day traders can probably limit themselves to trading the early portion of the day and trading the late portion of the day and get the best opportunities, the most opportunities and the most activity in those days, and they can take a nice long big fat lunch, which sounds like a grand idea to me.
Sir, behind it always Bollinger Bands don't even start to show.
Thank you. A great question. He says that the problem is in the morning when you start up, the Bollinger Bands aren't applicable because you don't have enough data to run them up to. What you need to do is splice your morning data onto the tail of the prior day so that you have a continuous series of bars, whether they're half hourly, hourly, 5 minute, 10 minute, that cross the night session. Right? And that way your indicators will be tooled up, ramped up, and ready to go in the morning. If there's a gap, then you're not going to be able to use them. But you'll know right away because you'll see the gap and you'll see the bands go wang, and so they're busted. Something's happened overnight. News has flowed into the market, and you haven't captured that news in your indicators. So you won't be able to use them that day. But on days where you don't get a big gap, then your indicators will be ramped up and working for the morning portion of the session. And a lot of people do this, and a lot of the software will do this. A lot of the software will allow you to splice in the portion of the night session that are applicable. And these days, on some of the sophisticated products, they'll pull the quotes from around the world as the different markets are open. You can get a quote on IBM out of Japan when it's traded there, and out of Germany, and then out of the UK, and then finally into our market, because the market day starts in Japan. Market opens in Japan every day and closes in San Francisco. That's the end of the trading days in San Francisco. Opening of the trading days actually in Australia. It opens an hour before Japan. So if you can get that data in some of these more sophisticated systems, you can use that, but I don't think you really need to. I think you need to capture whatever data is in your data feed and then splice them so that the indicators cross the barrier, and then disregard, be wary of that splice if there is a price gap. This is the typical volume pattern intraday. The vast majority of the volume occurs early in the morning, leading to a fairly dull period in the middle of the day, and then volume accelerates into the close. I think intraday traders probably want to be wary in here where the thin volume is and focus their efforts on preparing for the late session and participating in the early portion of the session. It's just you want to be, this is where the big price formation mechanism is running, and this is more random noise, and I think your indicators are going to prove to be a little bit less reliable in this period. Again, some comments on chart selections. Robust bars are a must, and this is how you gauge a robust bar. The bar is too short or non-robust if the close is often at the high or the low. So if you look at your bar chart and you're closing consistently on the highs or consistently on the lows of the bars, or alternating between the high and low of the bar, your bars are too short. All you're seeing is the price ratcheting back and forth between the bid and ask. Okay. High and or low unchanged from bar to bar. If you get a string of 3 or 4 bars with the same high, or a string of 3 or 4 bars with the same low, your bars are too short. You're not capturing the price formation mechanism. You're just painting the bid and ask on your screen.
So add more time.
Add more time. Lengthen the bars. Degenerate bars are a particular warning that you're using too short a bar. A degenerate bar, the open, high, low, and close all equal to the same number, or the open and low and or any two of them equal to the same number. If the open and high are equal and the low and the close are equal, again, it's a problem. It's a degenerate bar. It tells you that you're taking too fine a slice. You're not seeing the price formation in mechanism. And bars with no volume, again, a no-no. Lengthen your bars until they fit the price structure and you actually see the price formation mechanism in action. And conform your bars to reality, please. Stay in tune with the price formation mechanism. What are other traders looking at? Ask around. You know, what are other people looking at? Try to fit in with what's going on. You want to see what the rest of the world is seeing. Here's a particular problem. This is a short-term bar chart. Bars too short. Microsoft 1-minute bars. Here's a degenerate bar. Here's actually 4 degenerate bars in a row. Here's 1, 2, 3 bars in a row, all with the same high. Here's a 1, 2, 3, 4 bars in a row with the same low. Here's 3 bars that are identical, 2 bars that are identical, a couple more degenerate bars. You get the idea. This is not a reasonable chart to be looking at. And this is Microsoft. This is the most active stock there was at the time. This chart happens to be it's almost 2 years old. But this was, at the time, this was the most active stock that there was, and 1-minute bar chart was too short. Yes, sir?
When you're using a 5-minute, do you do your entry on a 5-minute, or do you go to your 1-minute to do your entry and exit?
I always separate the question is, if you're using a 5-minute, do you use a 1-minute for your entry and exit? I think that's a good idea, actually. I would actually go to a tick chart for my, it just draws all the ticks. It just draws every single tick, every single transaction is drawn as an individual data point. There's no time in the bars. It just keeps on drawing the ticks. That's a great way. I strongly stress that you keep track of your 3 different time frames. Your analysis is done on your primary chart. You use a shorter chart for your executions and a longer chart for your background analysis. If you're trading Cisco, wouldn't you like to know whether it's in a long-term uptrend or a long-term downtrend? So that you get off your long-term chart, you execute your plan and trade your plan on the intermediate term chart, and then you do your executions, your actual trade executions on a very short-term chart.
Just want to reiterate, because I didn't understand the show.
That could be. It's going to be different for everybody. Some people are going to trade on a 5-minute bar chart, and their long-term chart is going to be a daily chart. It's going to be different for everybody. I think if you're trading a 5-minute bar chart, your long-term chart most likely is probably an hourly chart. That would be my guess, but some people are going to use a longer one. Some people are going to think of it as a half-hour chart. It's really a matter of personal taste. What is important is that you be consistent once you've made the choices, and that you keep your tasks assigned to the right charts. Execution on the shortest chart, analysis on the intermediate term chart, background work on the long-term chart. So, and then here's that same chart drawn with 5-minute bars. Right? 1-minute bars, 5-minute bars. 1 minute, 5 minute. Each bar is now fully formed. You can see occasionally you get a couple of bars that have a similar high, but most of the bars are unique and independent. The closes are all over the place. The opens are all over the place. Here you're getting a genuine look at the price formation mechanism. You're not cheating yourself here. You're getting a real view into what's going on out in the marketplace. It's just incredibly important, this chart selection idea. That is the end of this session.